August 26th, a single Instagram post, a simple caption. Your English teacher and your gym teacher are getting married. A cultural moment, a love story, and a market signal that sends shockwaves through Wall Street. Within hours, shares of Signet Jewelers, one of the world's largest diamond retailers, jumped 6%. Brilliant Earth, another publicly traded jeweler, soared an astonishing 30%. Even Ralph Lauren, whose clothes the couple wore in the photos, saw its stock get a significant bump. This is a perfect example of event-driven trading, where non-financial news triggers major market moves. It's a challenge to the idea that markets are always perfectly rational and efficient. But look closer. Traders weren't buying Signet stock simply because Taylor Swift got engaged. They were buying it because they were forecasting the behavior of millions of her fans. The stock spike was the market's attempt to price in real time sheer power of her cultural influence. It was a collective bet on the coming demand shock she was about to unleash on the entire jewelry industry. And it all centered on this, the ring, an antique, hand-cut, old-mine brilliant diamond, a vintage masterpiece estimated between 7 and 13 carats, with a value that experts place anywhere from $500,000 to over $1 million. Almost immediately, jewelers were flooded with requests for similar vintage-inspired styles. But this wasn't just starting a new trend. It was intervening in a multi-billion-dollar corporate war. For years, the diamond industry has been in the midst of an existential battle. On one side, natural diamonds with the story of rarity, romance, and billion-year-old history. On the other, lab-grown diamonds, chemically identical, visually flawless, and available for a fraction of the price. The lab-grown market has been winning. By the time of the engagement, over 50% of engagement rings sold in the US featured a lab-grown stone. Their value proposition was clear, rational, and scientific. Enter Taylor Swift. Her choice of an antique natural diamond may prove to be a marketing masterstroke for the traditional diamond industry. It can single-handedly reframe the entire consumer debate. The conversation might shift away from a technical comparison of price and perfection and towards a narrative one of history, character, and uniqueness. The lab-grown industry's greatest strength is replicating flawlessness. The natural diamond industry's counter-narrative is that true value lies in a story that cannot be replicated. By choosing a unique, hand-cut, centuries-old stone, Swift has provided the ultimate cultural endorsement for that narrative. And in the battle for the hearts and minds of consumers, that's a powerful move. This immediate market reaction gave rise to the idea of a Swift effect portfolio, a basket of stocks poised to benefit from her Midas touch. This portfolio would include jewelers like Signet, luxury conglomerates like LVMH and Richemont, and apparel brands like Ralph Lauren and American Eagle. But here's the lesson for investors. The hype was fleeting. The initial stock pop for companies like Signet and Brilliant Earth faded from its peak within days, though it did settle at a higher baseline. Chasing the news is rarely a winning long-term strategy. The real Swift effect for a savvy investor is much more profound. A groundbreaking analysis by financial giant State Street found a statistically significant link between positive media coverage of Swiftonomics and the stock market performance of the entire consumer discretionary sector. One standard deviation increase in positive economic news about Taylor Swift was associated with a market valuation shift of over $12 billion towards the consumer discretionary sector. This story isn't just about one person's influence. It's about the economic power of a partnership. In business terms, the Swift-Kelce relationship is a merger of $2 billion empires. Her global music and media machine and his all-American sports and sponsorship domain. They are, in effect, a modern business family, amplifying each other's celebrity capital. And this merger has created a powerful market crossover. The NFL, which has long struggled to attract more female viewers, saw a double-digit jump in the demographic for Kansas City Chiefs games after Swift started attending. In the 48 hours after her first appearance, Travis Kelce's jersey sales spiked by nearly 400%. His podcast with his brother gained millions of new listeners, many of whom were Swift fans. The economic value here isn't just additive, her fans plus his fans. It's multiplicative. The narrative of their relationship has become a new product in itself, creating its own unique economic ecosystem. This ecosystem includes everything from official collaborations, like Kelce's apparel line with American Eagle, to a universe of fan-made merchandise on Etsy celebrating the couple. Even custom Lego minifigures. A new market with its own demand was created in the space where their two worlds converged. So let's go back to the counter-argument. Isn't this all just a reallocation of spending? The fan who buys a $300 replica ring isn't spending that money on something else. And that's true for a single transaction. But it misses the ultimate expression of economic power. The ability to capture existing spending is one thing, but the ability to shape future spending by creating entirely new trends is another. That's the difference between a transient market event and a lasting cultural and economic shift. And the evidence is already clear. High-end jewelers are reorienting their designs and marketing to capitalize on the Swift-inspired demand for vintage rings. The entire wedding industry is preparing for a shift. Experts predict a celebration boom where couples move away from performative luxury and towards the joyful, authentic aesthetic projected by Swift and Kelce. This could influence billions of dollars in wedding spending for years to come. This is the most profound impact of all. It's not about the short-term stock pops. It's about the long-term re-engineering of consumer desire across multi-billion-dollar industries. This forces those industries to adapt, to invest in developing new products and creating new marketing campaigns. That is real, tangible economic activity. The Swift-Kelce engagement shows us that the most powerful figures in our economy don't just participate in the market, they write the rules for it. If you enjoyed this deep dive into the economics of pop culture, make sure you hit that like button and subscribe for more stories that connect the headlines to the economy. Thank you.